Hey everyone, welcome back to Corporate Decoder, the place where we dig into the nitty-gritty of corporate filings to find the real story. And this time, we're uncovering a deal that seems a little too good to be true, involving warrants and a whole lot of stock. Stick around because this one's got some interesting twists. Today, we're looking at Actelis Networks, a company that's making some interesting moves with its warrants. Basically, warrants are like options, giving someone the right to buy a company's stock at a set price in the future. Think of it as a coupon for future stock purchases. So what happened is that on September 2nd, Second settled with a holder of some of their old warrants. Now these existing warrants were for buying shares of Actelis's common stock. We're talking about over 4 million shares here spread across 3 different sets of warrants with different expiration dates and prices. For example, some were set to expire in June 2029 with a price of 1.18 cents to buy a share in dollars from July 2024 with a price of 1.75 cents, warrants with different expiration dates and prices. Now here's where it gets spicy. Instead of just using those old warrants, the holder agreed to exercise them, but at a much lower price, just 0.37 per share. That's a massive discount from the original prices. In exchange for this sweet deal on the old warrants, Actelis is also issuing brand new warrants called new warrants. These new warrants allow the holder to buy even more shares, about 6.4 million of them also at zero bond, 347 tosen per share. So the company expects to bring in around $1.6 million from this deal. But remember, this is before they pay off their advisors. And speaking of advisors, they've got some big names helping them out. Rodman and Renshaw and H.C. Wainwright and Co. are on board as financial advisors. Actelis is paying them a pretty hefty fee, a cash fee that's 7% of the money they get from the warrant exercise, plus another 1% management fee. That's a significant chunk of change, about $112,000 just in fees alone, based on the $112,000 Bolzendrost in fees alone, based on the $112,000 just in fees alone. Based on the 1.6 million in fee, that's a significant chunk of change. About $12,000 just in fees alone, based on the 1.6 million in fee. And it doesn't stop there. The company is also giving these advisors placement agent warrants to buy almost 300,000 more shares. These warrants have a slightly higher price, 0.4625, but they're still getting a good deal. Plus, Actelis is covering their legal and other expenses totaling around $90,000. That's a lot of incentives for the advisors. Now, about these new warrants, they can't be used right away. They need stockholder approval, which basically means the company's shareholders have to give the thumbs up. Actelis plans to hold a shareholder meeting within 90 days to get this approval. Once approved, some of these new warrants can be held for 5 years and others for 2 years. This shareholder meeting is crucial. It's the green light for these new warrants to be exercised. Here's another interesting detail. There's a limit on how much stock one person can own. A warrant holder can't exercise enough warrants to end up owning more than 4.99% or maybe 9.99% if they choose of all the company's stock after exercising. It's like a cap on ownership to prevent too much control by one party. There's also provision for cashless exercise. If the company hasn't filed the necessary paperwork to allow the warrant holder to sell the shares they get, the holder can basically swap their warrants for shares without paying cash. They get shares instead of cash payment based on a formula. This is a way to make sure the warrants are still useful even if the registration process is slow. Now, about these new warrants themselves. Actelis isn't expecting them to be traded on a stock exchange. This means they'll be quite hard to sell or buy for anyone who isn't involved in the original deal. Liquidity, meaning how easily you can buy or sell something, will be very low for these. And until the warrants are actually exercised, the holders don't get any of the rights of a regular shareholder, like voting rights. They only get those rights once they become actual stock owners. However, they do get to participate in any dividends or distributions the company makes. There's also a clause for what happens if the company gets bought or merges, which they call a fundamental transaction. If this happens while the warrants are still out there, the warrant holders get to receive shares in the new company, or any other money the buyer pays for stock, based on the warrants they hold. It's a protection for them in case of a major company change. An interesting restriction, Actelis agreed not to issue more stock or file other registration statements for a period of 15 days after the closing of this deal, with a few exceptions. This is probably to prevent dilution or other deals from interfering with this particular transaction. They also promised not to do any variable rate transactions for a year. This generally refers to deals where the price can change based on market fluctuations, so they're locking in their future financing terms. Let's talk about the impact on the number of shares. Before this deal, Actelis had about 11.3 million shares outstanding. After this deal, once it's all done, they'll have roughly 12.5 million shares. That's an increase of about 1.2 million shares, which means existing shareholders will own a slightly smaller piece of the company. Some shares, about 3 million, are being held back for now to make sure they follow limits set by the original warrants. The filing also mentions that the full details of these new warrants are in an exhibit 10.2 for those who want to read every single word. It's important to remember that what we're discussing is just a summary. So, to recap the terms of these new warrants and the deal in general, they're offering a significant discount on exercising old warrants, essentially swapping them for new warrants at a much lower price. This brings in some cash, about $1.6 million, but also significantly increases the number of shares that could be outstanding in the future. So now, let's put on our analyst hats and see what this really means for Actelis networks. On the surface, this deal looks like a quick way to raise some cash and get some of those old warrants sorted. The big discount on the exercise price for the existing warrants is a clear sign that maybe the company was eager to get those out of the way, or the initial warrant prices were just too high for the current stock market. Bringing in $1.6 million can help with general corporate needs, which is always good for a company. However, we also see a lot of incentives being paid out to financial advisors, including hefty fees and more warrants. This suggests that getting this deal done was a priority, and they were willing to pay a premium for it. It also highlights the importance of these advisors in connecting companies with investors, especially for smaller or growth stage companies like Actelis. The need for stockholder approval for the new warrants is a standard procedure, but it also introduces a point of uncertainty. If shareholders don't approve, the new warrants won't become exercisable, and the company won't get the potential future benefits from them. The clock is ticking with a 90-day deadline for that meeting. The structure of the new warrants with different expiration dates and ownership caps is typical to manage dilution and investor relations. The cashless exercise option is a smart feature, ensuring the warrants have value even if the company's stock price doesn't skyrocket. However, the fact that there's no trading market expected for these new warrants means their liquidity is very low. This is not ideal for investors who might want to sell them easily. It suggests this deal is primarily for the original holder, who likely has a longer term strategy in mind. From a financial perspective, while $1.6 million is useful, it's important to see how this fits into Actelis' overall financial picture and burn rate. We don't have their full financials here, but any cash injection is helpful. The increase in potential shares outstanding, however, is a big deal for existing shareholders. As it could dilute their ownership percentage, they're essentially taking on more potential shares for this cash. What Actelis is doing here is essentially refinancing its own debt or equity structure. They're converting older, possibly less favourable obligations into a new set of obligations with different terms. The extremely low exercise price of Bolvor 37 or per share compared to previous terms like 1.18 or 1.75 indicates a significant change in the company's valuation or market conditions since those original warrants were issued, or a very aggressive negotiation by the warrant holder. The key risks here are shareholder approval, which could throw a wrench in the plan, and the potential for significant dilution if all the new warrants are exercised. On the opportunity side, if Actelis can execute its business plan, these warrants could be exercised at a profit for the holder, and the company will have raised capital without traditional debt. Ultimately, this is a strategic move to restructure some of their outstanding warrants, bringing in some much needed cash while also issuing more potential equity. It's a bit of a mixed bag. They get cash, but they also increase their future share count and pay significant fees. The success of this will depend heavily on whether shareholders approve it and how Actelis uses the capital raised. Alright, that's our breakdown of Actelis Network's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate filings. Don't forget to check out our Discord server linked in the description below. Thanks for watching. See you next time.